Let's get into the advisory now, with 2025 delivering another strong year of returns for superannuation members. So what is the outlook for 2026? Joshua Lowen from SuperRatings joining me now. Joshua, great to see you. Now, let's talk through your report here and I guess what we saw in terms of some of those strong returns last year.
Yeah, great to be here. Thanks. It was a big year for Super in 2025. So most Australians will be invested in what we call a balanced fund, and that returned 8.8% for the year. That's a bit down on what we saw in 2024, where it was 11.1%, but still a very strong year for Super, and comfortably above the long-term average.
So a good year, but I guess we're always looking, compare your own super fund. Is it doing as well as others? Which are the ones in your view or from your survey showed us some strong returns?
Yeah, absolutely. It was a really good year to be in a small fund, actually. The top three balanced option returns were all in smaller funds. So Ray Super took out our top spot in our survey. They gave 12.4% for the year. That was followed by Legal Super at 11.3% and NGS Super at 11.2%. So you can see those top performers sitting well above the average there of 8.8%. Good year to be in a smaller fund.
Absolutely. And in your view, what drove some of these stronger returns as well? We know that super funds indexed very closely to the overall share market. Was it international shares? Was it our share market? What did you see really drive these returns?
Yeah, perhaps unsurprisingly, it is that exposure to share markets, particularly the international share markets. So we saw good double-digit returns in US, Europe, Asia Pacific. So the international share markets did really well. Australian share markets did pretty well too, slightly less than some of those international ones, just under 10%. But funds with high exposure to international shares did really well. And it was less of the dominance. So 2024, we saw really the US shares were driving it. This time it's still international shares, but it's a bit more spread out across different regions.
So you talked about some of the small funds doing very well, and I think we saw Raise, Legal Super, NGS Super taking the top three spots. On the longer term performers, what are we seeing, and is it still some of the big industry names, or what did your survey show us?
Absolutely, it is still the big industry funds dominating those longer term returns. So if we look at the 10-year return for the average fund, balanced fund, that was sitting at 7.4%, whereas the big funds, that was Post Plus, took out the top spot over 10 years, 8.7%, followed by Australian Retirement Trust, and AustralianSuper was the other one in the top three over 10 years.
All right, Joshua, let's have a look as well in terms of what we've seen for passive versus active funds. What's done better in 2025?
Yeah, so passive funds, they're still relatively new to superannuation, but they have done very well over the last 3 to 5 years. And again, last year, passive funds did outperform the broader index. So the top funds there, they were all returning around kind of 10.5%. And that's really because they do have that greater exposure to the share markets. They tend not to have as much investments in kind of unlisted assets such as infrastructure or alternatives that you see in some of the big industry balanced funds. And so that's meant in this more recent environment, they have tended to outperform the more traditional investment classes.
When we look at younger superannuation members, what should they be doing to really try and benefit from some higher growth exposure? They've got a lot longer term to go until their retirement, but that also allows them, I guess, to take a little bit more risk here.
Yeah, absolutely. You do have to remember superannuation is a long-term investment. Even for members kind of in their 40s or 50s, you're probably going to be investing in super for another couple of decades before you start really drawing down on it. And so there is some benefit into going into those higher growth assets. There's some funds that will do it automatically for you. If you're in what's called a life cycle fund, they'll start you out with high growth assets and then move you into kind of less growth assets as you get closer to that retirement age. That can be beneficial. But you do have to just check that you're comfortable with how that's going to work. you are more likely to see bigger drops in your balance if the markets go down. But younger members in particular that have a long investment horizon generally have enough time to let it recover before they need to start accessing their super.
And how important is it for all of us, I guess, to be continually checking our super, to be really invested in this? Because for many of us, particularly with the housing crisis, Joshua, superannuation is going to be Australians' biggest assets.
Yeah, look, it's really important to monitor it. Probably less important to change it. So, as I mentioned, it's a long-term investment. You want to let it sit there and get that benefit of compounded growth. But we generally would suggest that you check it at least once a year. It can either be around statement time, which is usually kind of around August after the end of the financial year, or even make it a New Year's resolution. Check that the settings are appropriate, that you're in the right investment type for you, that your insurances, if you have any, are appropriate, and then try and focus on those long-term returns and block out too much of the kind of ups and downs over the short term, because you are going to be investing in super for a very long time.
And how tricky or challenging do you think this year is going to be for returns?
Yeah, 2026 is going to be an interesting one. We do see a few challenges on the horizon. A lot of what kind of kept 2025 relatively upbeat was, belief in the AI boom and the productivity that we're going to go see through that. So it'll be interesting to see if that can maintain the momentum into 2026 or if that starts to taper off. There's some rising geopolitical tensions you can see with some of the US actions recently. And then closer to home in Australia, there's still a bit of uncertainty around where inflation's heading, if it's going to tick up or stay where it is. And that means there's probably less of a chance for there to be another bumper year. We don't think it's going to be terrible and all negative, but we'd be surprised if we keep getting these kind of high single-digit, double-digit returns that we've been having for the past 2, 3 years. It's probably not sustainable.